Hello, everyone, and thank you for joining us today on our KJH Insights podcast. I'm Sarah Bull, a portfolio manager at KJH Investors, and as always, our goal is to provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I'd like to welcome Andrew Csumrik here today. He's a portfolio manager and a key member of the KJH investment team. Thank you, Andrew, for being here.
Yeah, thanks for having me, Sarah.
So, Andrew, we've got a lot to talk about today. The numbers really set the stage. So the TSX has held on, but the S&P 500, NASDAQ, and every stock in the Magnificent Seven is now in negative territory. And gold equities have also dropped, and even Treasury bonds are off. So really, in the month of March, it was a synchronized correction. And I would say one primary driver being geopolitical events and their impact on oil. And since the Middle East conflict began, oil and the S&P 500 have really had this 100% intraday correlation. When oil moves, the markets move, almost inverse. And as our CIO, Peter Barlas, said on our client webinar this morning, he's referring to it as a one variable market right now. Beyond that market volatility, you and Peter on the webinar talked about other stories that are unfolding. So today, Andrew, I think you and I should try to unpack some of the headlines and what's driving the current market environment, how KJH is thinking about the macro events, and how we're positioning through it. A lot to talk about, so let's get into it. So, Andrew, why don't right off the top, you talk to us about the current market correction?
Yeah, so I think if we look at the S&P 500 was pretty flat for the first couple months of the year. And then since then, clearly since the war in Iran, if you look at different indices, yes, they're down year to date, but if the actual correction itself, the S&P 500 down around 9%, NASDAQ down 11%, the TSX, while it is up year to date, it's actually down 8% as well. Russell 2000, which we quote a lot, that's 2,000 stocks, down 10%. So call it anywhere from 8 to 11%, which a correction, most people call it 10%. So I'd say we're right in around that area where equities are correcting. And actually, one of the stats that's been thrown around is 50% of the Russell 3000, which is an index of 3,000 stocks, is already down 20%. So half of that index is down 20% in bear market territory. So fair amount of carnage out there. And I think you nailed it too on the other side. Normally, when you go through these corrections, people look for safe havens. Gold is normally considered a safe haven, and it was a standout performer last year. It's down around 19% from its highs, and even bonds, because we've saw yields have been rising. Treasury bonds are down around 4 to 5%. So not really anywhere to hide there. And this has all basically happened in pretty much a month there. So I know you touched on geopolitical events that are causing this. And I think one thing that we talked about at our AIM, which is our annual investor meeting in January, everyone always asks for annual outlooks. And we kind of said it's very difficult to do because calling equities year to year is proven very hard. Even the experts, or the so-called experts, some of the smartest people, it's just there's so many variables that go into that. But we did say significant pullbacks are usually driven by one of three things, and that's interest rates. Rising interest rates can cause pullbacks. Unemployment, so you can categorize that with recessions. Rising unemployment aggressively usually leads to a recession, and that leads to big pullbacks. And then we kind of just said global disasters or exogenous shocks fill in the rest. It's really something you aren't predicting. You don't know what they're going to be. And at the time, we said the employment picture looked okay. Interest rates were in check. But what we did clearly get is that exogenous shock in the form of the war in Iran. We're kind of dealing with that exogenous shock at the moment. And that's led to, like I said, that kind of 8 to 11% drawdown in the main equity indices.
And you talk a lot about how corrections are a normal course of investing. And I think the stat is something like since World War II, there's been 105 pullbacks of 5% or more. How do you use that in context of this market correction?
Yeah, that is the stat. I like the line that I heard. Volatility is the toll we pay to invest. And so no one ever likes corrections. We're in the business here. They're painful for all of us, but they are a normal part of market cycles. And so the biggest thing is you get 5% pullbacks kind of all the time. And it's more, do those turn into a correction? And I think the stats roughly around a quarter of those turn into a correction. And then, half of those that turn into a correction turn into a bear market. And so it's not necessarily clear. And at the time, I think every time you go through a 5 to 10% correction, you're worried about it getting much deeper. I think what we're doing and why this one is probably a bit unique is it's just a geopolitical event. There's nothing that you can simply put into a spreadsheet, as the financial markets like to do, and you talk about outcomes. If the war ended tomorrow, I think that's very different than if the war stretches out 6 months to a year's time. And so at the moment, this is, I would say, the normal price of investing and being part of equity markets. And it's not fun to be a part of at the time, but it's also not abnormal. That's kind of how we're viewing it.
And what does oil prices sitting at around $102 a barrel? And you've talked about tanker traffic through the strait has essentially collapsed. What does that mean for inflation?
So I think there's a few things, and you kind of touched on it. I think let's take maybe a bit of a step back and why this one is so unique in terms of a conflict that we're having here. And basically, if you think of the strait that you called it, the Strait of Hormuz, which maybe a lot of people wouldn't have been able to point it out on a map prior to March 1st, but now it seems like it's being discussed daily. 20% of the world's oil volume goes through this strait. And so Iran has basically weaponized the strait. And as you mentioned, no ships are going through. And so what impact does this have? And I'll probably say once again, it kind of depends. So the first reaction is we've seen oil prices up around 80%. And that immediately flows through to what you see at the gas pumps. And it's probably the quickest mechanism of seeing it when you think of other things. If plastic prices are going up, you may not see it come through in the retail shelves for, 3, 6, 9 months later. Then you start seeing rising prices. Gas is probably the quickest mechanism that you see. So it's clearly having a sticker shock. Inflation in of itself is probably debatable on what it does to it. So the immediate impact on headline inflation will be higher. I think that's just a simple fact. But a lot of people focus on core inflation, which actually excludes energy prices, energy and food, but obviously energy being the big one today. And so if you think of this short burst in oil prices, it won't actually have a major impact on the core inflation, but the headline inflation will definitely be higher. But if you take it one step further, and I think what the market is kind of grappling with is say oil goes to 120, 150, even higher, there's a point where those gasoline price increases or just input costs to normal corporations starts having demand destruction. And so when that happens, it doesn't necessarily matter that the input costs are rising. You're going to have demand destruction, and that could have the opposite impact on inflation. So I do think there's a little bit of a uniqueness to this, whereas we think back to the last time we saw really elevated inflation during COVID. Demand was strong the whole way through. Once we got the stimulus checks, we just couldn't get supply. So the aftershock of COVID, demand was strong. We didn't have the supply, and that really drove prices higher, and they were more sustainably higher. This time, there is a point where the driver behind inflation, being oil prices, probably hits a level that does impact actual demand.
And that level, is it sort of 90 to 110 or 120? What is that level?
There's no exact number. I wish I knew exactly what it was, but I also think it's duration. So there's two things to keep in mind, and we did talk about it in the webinar. The oil price that we hear and gets quoted every day, and that matches the fuel price at the gas pumps, that is considered spot price. And so that is what you're paying if you want a barrel within the next month, a barrel of oil. And that moves around pretty aggressively, mainly due to we can't get barrels out of the Strait of Hormuz. But what a lot of companies and corporations and hedging corporations and financial pundits are able to hedge, they look out longer. And so we call that the long end of the curve. And one area would be 9 months out. And so that's what you're paying to buy a barrel of oil 9 months out. And that really hasn't moved nearly as much. And so right now that level I think today it's around $70. I think it reached up to around 75 or 80, but not the 110, 120 that we've been hearing those spikes. And that same price was around $60. So 60 to 70 today, meaning it's only risen $10. And so the reason I bring all that up is right now the market believes this isn't a structural long-term issue. This is a short-term conflict, but the longer this goes on, they will be repricing that longer dated oil price higher. And I think that's when you start to see real demand destruction, because if the duration is short, everyone has savings, everyone still has their job. It's more when it starts getting longer and longer, it tends to make its way through the economy more. And I think that's whenever you see the impacts. So I guess that's a way of not really answering your question. I don't have a dollar amount. It could go to 200 for 2 days and come back and we'd probably be fine. But if it's elevated for longer periods of time, I think that's when you start worrying about the economy.
No, I think that was a really good answer because I think in large part it really is dependent on diplomatic efforts and how long this war is going to go on for. So I think that was a really good explanation actually. And then that kind of brings me to the next question, which is the Fed. So there's differing thoughts now in terms of rates and where the Fed's next move is. Can you expand on that for us?
Yeah, I think it's a good question to bring up for a couple of reasons. First off, when we entered the year, it was one of the bullish factors for equities was that interest rates were heading down. The market had priced in a couple cuts from the Fed. It was pretty obvious to most that interest rates would be coming down in an easing cycle. And as soon as this happened and you see oil prices rise, inflation expectations start rising, the market actually immediately started pricing out those cuts and actually priced in hikes coming in later this year to offset the potential inflation. Since then, the market is now pricing in flat. And I would say what that means is nobody knows what the Fed is going to do. And I would say similarly, the Fed is on hold right now. And so it kind of goes back to what I was talking about on demand destruction versus inflation. The history shows I don't think the Fed will be overly aggressive to hike rates just because I think they understand if oil prices stay higher for longer, what they're trying to combat might fix itself through demand destruction. And then their other side that they try and their dual mandate will be elevated unemployment and then they'd have to go the other way. So our view right now is probably they just continue to be on hold. So you've kind of lost that tailwind of an easing cycle. But I know most were saying they're obviously going to have to hike because of rising interest rates. I'm not sure we're quite there because of the scenarios that I was talking about of rising oil prices might actually tighten for the Fed.
Thanks. Let's look back at some of the other themes that you are thinking about and talk a little bit about AI disruption and just how the AI narrative really shifted this quarter. Which sectors do you think are exposed to this disruption and how are we thinking about AI now?
I can't believe we've gone this long. This will be the longest we've gone without talking about AI in the last 2 or 3 years.
Oh, I know.
Um,
It's usually the first question on my list for you, isn't it? It's amazing.
yeah. So it kind of has taken a back seat for obvious reasons, but it wasn't that long ago, actually, just in January or February that you mentioned it, it was having major impacts on the market. And really what we were saying at the time, you had years of mega caps leading the way in stock returns. And the market was beginning to broaden out. And the technology sector was actually getting hit from two ways. So on the one side, investors were starting to question the mass amounts of capex that hyperscalers were spending and if the future returns would ever justify it. And I think you mentioned it at the beginning, all the Meg 7 names are down and they're down pretty significantly year to date. And so that was the one story to start the year. And then on the other side, the advancements in AI were changing so fast. The improvements were accelerating to the point where people were questioning almost all software business models. So for us last year, we did reduce exposure to a lot of the Meg 7 names mainly due to elevated valuations and just seeing better opportunities in a broadening out environment. But if you think about what happened to the Mag 7 so far, they're down 10 to 25% year to date. But that actually pales in comparison. The main story of the beginning of the year was software companies. So if you really think about this, software have been some of the best performing companies and stocks of the past decade. They had the asset light business models, great recurring revenue, high margins. They benefited from not only growth, revenue growth, but also they were seeing significant valuation growth. So they were some of the best performers. And companies like Salesforce, Shopify, Workday, Snowflake, like these are, if you're in the software, these are household names. They're ingrained in, probably most of the Fortune 500 companies, they were down anywhere from 35 to 70% from their highs. And so these are large market caps, pretty disruptive stuff. And if people are kind of saying, what, this is just a great opportunity, when did you ever think you'd get some of these big companies and great companies selling off like that? I think it's worth looking into why it was happening. And the worry was really that AI is getting so good that the AI agents could code and build software at a speed and quality that a lot didn't expect. So you might have heard the term vibe coding. It's where people were able to use AI to code their own software basically over a single weekend and replaced some of the software that had been ingrained inside companies for so long because switching costs were hard. Actually building it took time. It took a huge team of engineers. And so that kind of flipped the script on its head. And so it led to a massive re-rate lower for software stocks. And they're probably the cheapest they've been in the last 10 or 15 years.
Yeah, software valuations have really come under real pressure in here, haven't they?
Yeah, I mean, we do get a lot of questions on, is it just a great opportunity? But really, our messaging is that we're taking a patient approach here. It's very hard to predict where artificial intelligence is heading because the rate of change is exponential. And even the experts that we speak to, they get surprised all the time at where things are going. And so it's likely there's going to be companies whose business models are actually severely impaired longer term. But that being said, we do believe that this shift will also open up massive opportunities as the profit pool shifts. Businesses must transition, and there'll likely be a lot new businesses formed. Like anytime there's these technological breakthroughs, it's just we've never seen one this large and at this speed. So we just think it's too early to see who those winners are. But in the next cycle, we do believe there's some great opportunities. But for now, we're kind of patient on the sidelines.
Yeah, no, I think that's good because you've talked about us being in an AI super cycle. And I think what you've just reminded me and probably our listeners is that with volatility, everybody's time horizon shrinks. Our clients start really paying attention to the daily moves in their portfolio when really they have many more years of investing. So I think that's a good reminder, even with the AI shifts we've seen, is that we're still in an AI super cycle and it's a little bit of change right now.
Yeah, for sure. I think the super cycle is still intact. It's still a massive implication for investing, but I do think it's a transition point at the moment.
So, Andrew, moving on to how the KJH team is positioning through these themes, I really liked your comment volatility is the toll we pay to invest. So, how are you thinking about dividend growers, credit? How are you building resilience in this noise?
Yeah, I think first off, just at a high level, we try not to overreact to these shocks like we're seeing today because they are hard to predict. And generally speaking, when you make major moves in response to them, you're already too late. Getting whipsawed by headlines probably now more than ever. I mean, intraday, somebody and we always get asked like, what flipped the market? And I was like, another headline, another truth post, truth social. So I think that is important to try and stay calm during these times. But we do focus on the overall allocation and take advantage of volatility to reposition the portfolios. And so, as an example, some of our, if you think of an income mandate that we have, we did reduce equity exposure in favor of more fixed income. But the reason here was really twofold. It was on the one hand, it's a more conservative fund, so reducing equity exposure reduces the risk of more downside of what we call tail risks, meaning that it's not our base case, but if the conflict goes on for 6 months or a year, oil moves to 150, 200, inevitably leading to a recession, we can reduce that exposure. And the second being taking advantage of rising interest rates. So Canadian bond yields had risen roughly 50 basis points, which is 0.5%. And this is meaningful off a base of around 2.5%. So that's one example of the action we took really within a balanced mandate. But if you think of our core equity mandates, we're not trying to call market tops or bottoms. It's extremely difficult to do. We'll look to reposition as we see what we like to look for longer term themes sell off, but we still believe in the long term. So generally what happens during corrections, all equities sell off together and correlation of equities go to one, meaning they're just moving together. But even if the reason, like today, some of the reason for the sell-off solidifies an underlying thesis, that's when we try to add to some of our core positions.
I think that's right. I think oftentimes I hear you say that there can be opportunities that you're able to uncover through volatility.
Yeah, for sure. I think that's important.
So, Andrew, I think sadly we're coming to the end of our time here and we should wrap up. But is there anything you feel, any hotspots or any themes that we haven't touched on that you think we should dive into before we close up here?
Something we are warming up to a bit more is some themes here within Canada, and it's really driven by the world going through a structural change at the moment. So you think of global supply chains are being broken down, global trade being disrupted, the AI super cycle I touched on, and national security. A lot of these are all coming together at the same time, but we actually believe that they're allowing us to have more exposure to Canadian companies just because we are so rich in natural resources. We have critical minerals, critical metals, and then defense would be another area. If you think of NATO going from 2 to 5% of GDP of spending and really putting politics aside, I think the message is clear that the US may not necessarily be there with their military at all times. So the message is you need to spend and build up your own defense. And I think Canada is one of those countries that is doing that. And we're seeing it in a lot of our portfolio companies, potential benefits coming from that. And there'll probably be new companies. So I guess I would just leave as a bit of a teaser there. There is a structural shift going on around the world, and we are invested alongside some of those themes. And I do think there's opportunities in Canada here that we own today and we look to add to more in the future.
I think that's important to reinforce, right? Because a lot of our clients and a lot of the funds have quite a bit of exposure, obviously, to Canada. Yet we talk so much about the US, and there's a lot going on in Canada. And in fact, a lot of what's happening geopolitically is a war for things that are in the ground. And that's what Canada's economy is driven by.
Yeah, and I think again we talked about the US a lot just because it's such a big driver of global markets. I think it's 50 to 60% of the global market capitalization, but that doesn't mean, we are Canadians. We have a home court advantage here. We know the regulatory environment. We know a lot of the management teams. We talk a lot about it because I think that drives the global flows, but I do think there's a bit more of an opportunity, and we've been shifting more so towards the Canadian side, I'd say, in the last 6 months or so. I do think the structural changes globally are driving that.
And so, in your mind, when you say the structural changes, do you mean energy sovereignty and Canadian defense primarily?
Yeah, and just if you think of the current trade, what was happening before was you had all these countries or companies within, call it the Western world, who was focusing on just-in-time inventory, meaning that all their manufacturing capacity was moving overseas. And now today, I think we're clearly seeing more separation between China, North America, the US specifically. And so these Western companies are now being looked upon as being we need a supply chain that's more redundant as opposed to just the cheapest supply chain. And I think we have the ability to fill that. So yes, it's defense, yes, it's critical minerals, but just all of those things will foster new industries, manufacturing coming back. Not to mention, energy independence. We have a lot of resources. Natural gas is extremely important for the AI super cycle I spoke about. So it's not going to happen tomorrow. These things all take time. They're longer themes, but there is reasons to be optimistic on that side.
So, Andrew, I know we can continue talking. There's so much to speak about right now, but we covered a lot of ground today. And that's because what we're living through right now is not one thing, it's a convergence of so many factors. And so I really liked what you said. Volatility is uncomfortable, but staying disciplined and positioned appropriately is where long-term wealth is made. So thanks for that. And thank you, Andrew, for your insights. I know our clients really value your opinion. And thank you to all for listening. If today's conversation raised questions about your own portfolio, please reach out at any time. And as you know, we love hearing from you. We look forward to speaking to you again next month. Stay well.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.